Welcome to this week's Market Matters weekly video update. I'm Harry, joined by James Gerrish. Today for Thursday, the 18th of August. We're in the middle of reporting season, James. Feels like it's been going on for a few weeks now, but there's still another 2 weeks left of this period's reporting. It's sort of a top-level view of what you've seen 3 weeks in to this reporting season, James.
Mate, we go twice a year. The US do 4 times a year every quarter, so you should consider yourself lucky that we're not over there in the US, and we've got a small fraction of the companies that they have. So toughen up. It's actually we're jovial now because we've been through the first bit of reporting. It's been okay. So there was a lot of concern going into this full year 22 earnings period that obviously the economy was slowing. There was the backdrop of sharply higher interest rates to curb rampant inflation. There was some concern around a lot of sectors, so retail and property. The banks feed into that as well. So there's a lot of negativity going into this reporting season. It's been better than feared. We've been writing about it. The media's no doubt been covering it. The market's rallied overall during this reporting season. So that tells you in aggregate it's been better than the downbeat expectations that we had leading into it. Some sectors, some companies have done better than others, and there'll always be that variance across the board, but overall it's been positive.
Two sectors that have earnings that are reasonably well linked, property and the banks. We've seen a lot of those companies in those sectors report so far. How have you seen those two sectors so far?
Yeah, I mean, the banks are a really good broad indicator of the economic situation that's playing out in Australia or in any economy really. So we've seen a couple of things. So the earnings have held up pretty well. Asset quality has been better than expected. Margins have been lower than we thought. So what's happening there is that the benefit of higher interest rates has not been fully realised in the period. So obviously higher interest rates have come through at the back end of the period. So we haven't seen the full benefit of that. They all, the majors have guided to better margins. Bendigo's result was probably the main disappointment out of the bank reports this time around. They're saying that margins won't be improved. They won't have as much leverage to higher interest rates as we thought they would, and that's why we've recently sold out of Bank of Queensland. But overall, I mean, the banks are saying things are okay. We've got heaps of capital on the balance sheet. We're not seeing any underlying issues from an asset quality point of view. Our borrowers are in good shape, and that'll continue as long as employment stays strong. So banks have given a tick of approval for the Australian economy at this stage. And you mentioned property. I mean, the market was so downbeat leading into this results period around property and what they deliver. Broadly speaking, our real estate companies are in, they've had a good 12 months. They're guiding to marginally lower earnings, or at least flat earnings and dividends for FY23. Some are slightly down on FY22. Leverage gearing is low. Some have hedged a lot of their interest rate risks, others haven't. So there's a bit of variance there around the risk profile around rising interest rates. But overall, I mean, I like property down here. I think it's been sold off. You look at Dexus, it's down 40% from its highs, and the outlook, their earnings for FY22 and their outlook for FY23 is not reflective of that move.
The resources, they've seen some pretty big numbers so far this period. BHP in particular, I think it was their second biggest print for a reporting period. It's a sector that is aided by inflation, but it has also had troubles with inflation of late. James, how have you read into those resources reporting so far?
Yeah, you're rightly so, Harry. So wage inflation in particular, and also the rising cost of getting stuff done. So we've all felt it across many parts of the economy. Obviously, earnings, as you may mention, have been great. So BHP was huge. The dividend was huge. What I'd say there is I guess in the short term, it's around whether or not we peak earnings for these sort of names. Obviously, commodity prices have been really high. They've benefited from that. They are paying a lot back as dividends, but something like BHP, going forward, they'll pay less out as dividends and reinvest more for growth. They made a bid for Oz Minerals. They got a bunch of other projects they need to fund. So there's going to be higher capex more retained earnings for future growth and less dividends for the miners going forward. So, they're in good shape, but I think we've had peak dividends out of the miners. So from an income investor point of view, that's how we'll be thinking about the sector from here.
Rocky always says, "Don't buy a resources company for dividends," and you do tend to see.
But then he says, then he talks about how good the dividends are. So,
the retailers, we sat here a couple of weeks ago, James, and talked about how downbeat everyone was about the retailers. We have bought a couple of small positions across the portfolios in the space, but now seeing these numbers come through, is that reflective of how poor the market did think about these earnings for retailers this period?
No, and I think we wrote about Walmart yesterday morning, and I spoke about it in the podcast in the yesterday morning. It's a really, it's a huge global retailer, but it's obviously massive in the US, and its customer base is basically the US population, so all parts of the US population. They thought a couple of months ago their business was in trouble, and they had two profit downgrades as a consequence of that. Massive inventory build. They weren't seeing the sales, so they downgraded earnings expectations. They've come out and said that actually earnings aren't going to be as down as what we thought, as much as we thought, and inventory's been, people are buying stuff, so inventory's coming down. We've actually seen a turn. So I think the US economy is probably a bit ahead of the Australian economy in terms of interest rate hikes, the slowdown they've had, now the recovery that they've had. The US generally leads the globe into issues and out of issues. So I think that's a good read through for Aussie retailers, and that's what we're seeing. FY22 results for companies like Super Retail Group yesterday were pretty positive. There was a bit of confusion around the 53-week period, and that's what made their earnings look a lot better yesterday. So the stock popped, but overall, the trends are still good. So take the roadmap from something like a Walmart, and I think the outlook for retailing is improving. Obviously, interest rates and how the economic situation plays out is going to be important, but overall, I think it's fine for now, and the stocks have been sold down too far.
Is there anything else, James? We've touched on some pretty big sectors today so far. You've covered off a lot of big chunk of the market, but is there anything else that we're missing in this reporting season that you've seen?
I think a couple of fireworks that happened in the e-commerce space are staying with the retailers. Temple and Webster came out and reported better margins than expected. So I think that's going to be a lot of these companies are, Adore Beauty, which has been a really poor position for us, but it started to move higher as well. If some of these companies can say, they can tweak the dial and improve their earnings, and Temple and Webster is showing signs that they can do that, then they'll really rally strongly. These stocks are a fraction of what they were only a couple of years ago. So e-commerce, I think, is starting to improve, and I think that's an area that we should have a bit more focus in. And I think some of these the infrastructure type stocks, the Transurban's out today and saying the dividend is going to be lower than where we thought it was going to be because of cost pressures. So to me, that's probably an area where the defensive infrastructure style things, and we've just sold APA Group in our income portfolio. I think that's an area where we should be lightening the load a little bit. So portfolio's got to be dynamic. Overall, we've raised some cash in the last little while. Just to finish on that note, and we're anticipating the market it's probably had its run, or the majority of its run, on the upside. It's up 11% from its lows. So raise a bit of cash and then approach the back end of reporting with a bit more flexibility.
Awesome. James, you made mention of the podcast. We're doing 2 podcasts a day at the moment on SoundCloud and on the website, if that's where you access it. But otherwise, join us next week for next week's Weekly Market Matters video.